Welcome to the latest Motley Fool scoreboard. I'm on in Chalk Blue. We've got longtime fools Matt Frankel and Jason Hall giving a 1 to 10 rating to one of the rare steak places I haven't eaten at yet. But both of them have. It's Texas Roadhouse, ticker symbol TXRH. As always, we'll do a 10-second bull bear. We'll rate Texas Roadhouse's business, its management, and its financials. We'll talk valuation, and if there's time, fools, we'll play Armchair CEO, and we will top it all in about 12 minutes or less. So let's get to it. Jason, give us the bull bear on Texas Roadhouse.
Well, I think we have to pause for a moment just in sheer awe of working in that dad joke there. Rare steak houses. So good, Anand. So good.
Thank you.
You know what else is good? How incredibly well Texas Roadhouse is run. This is one of the best run restaurant chains in a very tough business. And Matt Frankel on here with us, he's going to talk about that. He spent years in the restaurant industry. They focus on really great food and a fun environment and just hammering their operations and delivering exceptionally well. The bull case, the growth story isn't over, and it can continue to deliver operating and profit margins that most restaurateurs would literally sell their families to earn. Not figuratively, but literally. The bear case, though, is consumers are starting to get squeezed, and that leads to a persistent downturn in eating out at pricier places like Texas Roadhouse. That cuts into profits because the bottom line is if you're a restaurant and your revenues fall just a little bit, it really undermines your economic results. And then that forces it to slow its growth, undermines the entire thesis, and undermines investor returns along the way.
All right, getting further into the business, Matt, scale of 1 to 10. 10 is invincible, 1 is hopeless. How do you rate Texas Roadhouse?
I'm still trying to process the fact that you've never eaten there.
I know.
But no, a lot of people don't know this about me. After college, I took a gap year that turned into a 5-year stretch as a restaurant manager. So I know this business very, very well. And it's a tough one. If I were to rate the industry, I'd probably give it a 2 or a 3. I know a lot of like the angel investors, venture capital type people who say, don't pitch me a restaurant. Like that's a standing rule. It's a tough business, but the company has executed very nicely. It's more profitable than many of its competitors are. And it's not just that consumers are being squeezed. Restaurants are being squeezed too by inflation. Food costs are going up. Labor costs have gone up significantly in the past few years. Insurance costs, a lot of bars and restaurants in South Carolina where I am are closing specifically because of spiking insurance costs. So it's a challenging environment right now, not just on the consumer side, but for the restaurant side as well. And there's, as a former restaurant manager, there's a very limited ability to pass those higher costs on to your customers without the business just crumbling. I think Texas Roadhouse just did a 2% menu price increase. I can promise you their food cost increased by more than 2%.
Yeah, I agree directionally with a lot of what Matt said, with the caveat that even though, yes, there's definitely times when things are going to be hard and it can be harder to pass along those prices, but across the economic cycle, this is one of the very strongest restaurant brands and one of the best operators. I think when you factor that in with some of the things we'll talk about with the financials, this business to me is worth a 7.
Right. And I did just double check that I don't have a Texas Roadhouse super close to me here. There are some in the further suburbs, and growing up we never had one. We had a West Texas Roadhouse that I did eat at, but unrelated. And that was pretty good too. Matt, let's talk about management. Scale of 1 to 10. 10 is Warren Buffett. 1 is Homer Simpson.
Restaurant managers don't tend to last long, and theirs have. I was a 5-year restaurant manager, and most don't make it in the business that long. So their CEO has been in the business or been with their business since 1997 and took over. He's only been CEO for a couple of years, but the leadership team in general, all of them have decades with the company for the most part. The company's president has been there almost 30 years, chief communications officer almost 20 years, and I could go on with that. And a great track record of producing growth and investor returns, which is, like we said, really tough to do in a sustained period in the restaurant business. Because as Jason and I have both said, you'll have challenging periods, you'll have good periods, but it's really tough to consistently produce decent margins and returns.
Yeah, Joe Morgan was founder of Kent Taylor's right-hand man for decades, literally decades. And he had a really tough act to follow when Kent Taylor died, sadly by suicide in 2021. He's proven his mettle so far. And again, I don't think you could find somebody that understands the business better to have to come in following a founder. But I do want to point out one thing, though, is that he's led the business through a really good economic period. Consumers have had lots of money to spend. They were looking for a reason to spend it coming out of the pandemic. The question's, is he going to be able to guide it as well when we do go through the eventual periods where consumers are kind of closing the purse strings? So for that reason, I'm saying 7.5, because it's a big difference moving into the big chair and delivering on the strategy than just being behind the scenes where Morgan's been for most of the past 3 decades.
Financials time, Matt. 10 is a fortress, 1 is yikes.
9, 10 for a restaurant. Virtually no debt for a restaurant chain is a rarity. Even mom and pop restaurants it's rare to see one without any business loans or anything like that. They have very high margins for a restaurant operator. A net profit margin of like 5% is a restaurant doing well. It's not a very high margin business. The company steadily raised its dividend and repurchased shares. And unlike a lot of its competitors, it doesn't just repurchase shares constantly to drive returns. It does it specifically at times where it makes sense. I really love the capital allocation there.
When you're a restaurant, like you start if you have a really good brand, right? That's attractive and appealing. That's really good. And it's also the kind of food that consumers want to buy, not just that's interesting now, but has staying power, like steakhouse, burger chains, Mexican food, like those like timeless sort of foods. I think that's really important. You start there, and then you have to be a really good operator too, because like Matt said, price always matters. You have to be really good with operations. And then the other thing too, you want to grow, you want to allocate capital really well. If you can do 2 out of those 3 in the restaurant business, you're doing pretty well. They do 3 out of 3, and it shows in the financials. All the things that Matt's already talked about with the economic returns of the business, the margins they get, the strength of that balance sheet, not leveraging a bunch of debt to grow. It's really, really impressive how disciplined they've been, great operators, and leaning into the timeless product that they're selling and their really good branding to deliver the great financial results that they have.
Jason, let's talk valuation now. Our quant team rates Texas Roadhouse as cautious on the cautious, moderate, aggressive risk-reward spectrum. How well does Texas Roadhouse's stock do over the next 5 years? And how safe is it, remembering that safety scale of 10 is a sure thing and 1 is a lottery ticket?
I'll give it a 7 for safety, just because, again, the balance sheet is strong. The return profile is very, very good. And you think about it across a full economic cycle, this is a business I think investors have a pretty good chance of earning some good return over a 5-year hold. But thinking about what kind of returns you're going to get, if you'd asked me a year ago, I would have given a higher expectation. The stock has run up a lot, and it's not because of earnings growth. So we've seen a lot of multiple expansion. So we should expect lower returns from the price that we're at now. So I'm going to say 5 to 10%. And it could be at the lower end of that range just because of the multiple that you'd be paying to buy it right now.
Yeah, I said a 6 for safety, more mainly because of the inflation risks that I mentioned right now, not necessarily just the consumer risks, but a 5 to 10% return I would agree with, probably at the higher end of that range. But the reason I said not higher is just because a lot of growth seems to be priced in. The stock has more than tripled over the past 5 years. So that's from the pre-pandemic price, not just from like COVID lows. It trades for about 27 times forward earnings. And with the challenging environment, I just don't see it tripling again in 5 years. I think it'll be more of a muted return, but still decent performance.
Armchair CEO Jason, what are you doing differently at Texas Roadhouse?
I'm going to take a play out of the book, The Outsiders playbook here. And one of the things that really good capital allocators have done over time with businesses is not just being smart about when they buy back stock when it's cheap, but think about using your equity when it's expensive to spend. And I would say let's maybe think about issuing some equity at higher multiples, bolster our balance sheet, position the business if we do see an economic downturn where we have the capital to continue to focus on expansion in a moderate way. And maybe right now selling a little bit of stock to raise a little capital might be the way to do that. I'll talk to the board on day one about that.
Yeah, I can't find that much wrong. I might pump the brakes on growth until the inflation question is more stable. And I don't think that I mentioned the 2% menu price increase. I don't think that's the last one they're going to have to do to get their cost structure right. So I might pump the brakes on their new restaurant ambitions for just the time being. And like Jason said, is it a great time to issue equity? You can make the argument that it is with the stock tripling over the past 5 years, that it's a great time to issue equity. But I would probably slow down the growth for the moment.
I love that. People don't talk enough about that. The GameStop technique, right?
Yep. Right. Absolutely.
Let's top it. Jason, is there a company in Texas Roadhouse's space you actually like more?
So Chipotle is really interesting to me. So the thing that it has in common with Texas Roadhouse is we've seen a ton of multiple expansion. And like Texas Roadhouse, that multiple expansion has happened because the business has delivered really, really well. Talk about high margins, their opportunity to continue to grow and add locations, right? Those things are still in place. The reason I think that Chipotle to me may be a little more interesting is I think there's more growth opportunity, ability to grow actual locations internationally, not just in North America, but also their ability to expand into more day parts, I think is probably better than a Texas Roadhouse, which is a full sit down, you go in kind of thing. And it's harder to do breakfast at high margins in enough volume for a Texas Roadhouse. But Chipotle could eventually move into more breakfast on a wide scale and increase that day parts and get the kind of margins that they get from their lunch and dinner menu.
I say Starbucks. Starbucks has been beaten down because of some of the reasons we've mentioned for Texas Roadhouse. The consumers being squeezed right now, slowing discretionary spending. I just think it's a rare opportunity to buy a great brand on sale. And I think the management team's doing a good job of trying to right the ship. So I've been buying Starbucks lately and probably will continue to do so as long as it stays at these levels.
Absolutely same.
Definitely agreeing on Starbucks. And man, if fried chicken from Kentucky can sell in China, maybe steaks from Texas can as well. Thanks to both Matt and Jason. They've given Texas Roadhouse a solid overall score of 7.0 out of 10, with returns expectations muted due to valuation concerns. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is a REIT. Till then, Fool on. No, I need to eat there.
You've never eaten at a Texas Roadhouse?
No.
Oh, wow.
It's not.
That's what we're doing. Hey, before poker, that's what we're doing.